It's time for the midweek check-in here on Stonkcast. Folks, in case you've been under a rock, meme stocks are back. We got Opendoor, of course. We got Rocket Mortgage. We even got Krispy Kreme getting in on the action. We're going to break down all the latest in the meme frenzy this summer, and I'll lay out why I believe you should probably be paying attention to Opendoor. Also, we will lay out some of the key earnings that happened on Wednesday, the Magnificent Seven. We had Alphabet, Tesla reporting. We'll get into that. Also, some key tariff news from President Trump on Wednesday as well. Stick around for all that and much, much more. Make sure to like, subscribe, and follow wherever you listen to podcasts. And now, folks, let's get into it. Welcome back to Stonkcast, the market show for the average Joe, whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor. We've got you covered. We break down the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Char. Welcome back, folks. And first of all, let me just say, for any newbies here, because we've had such an uptick of late in support and subscribers on the channel, most likely due to Opendoor, I just want to say welcome. We hope that we can be your go-to channel for all things market related. And now, without further ado, let's get into it. Let's do a quick market breakdown to see how Wednesday looked in equities. So first of all, this according to CNBC, Dow jumps 500 points, S&P 500 closes at another record on Trump trade deal optimism. So Wednesday was a big day in the market. If we do a quick check-in on the S&P 500 via SPX, we did indeed hit a new all-time high. And in case you've been following the show for a while, I had some Fibonacci extension levels laid out for the S&P, and we busted right through the 50% extension level on Wednesday, which was 63.34. I've been calling that one out for a while now. And we broke right through it. Very solid green candle on Wednesday, clearly above all major moving averages. And we just continue to rip as we get promising news. We closed at 63.58. If we do a quick check-in on the NASDAQ as well, looking pretty good. It was really the only thing that was down on Tuesday. You had the S&P up, but for some reason you had the NASDAQ down 0.5%, but a nice bounce back on Wednesday, and looks like it wants to close in on a new all-time high itself. We do a quick check-in on IWM, the ETF for the Russell 2000. We've had some consolidation here, sitting above the 200-day moving average, and then on Wednesday we had a nice clean break above some of that consolidation there. The all-time high on IWM is 244.98, so it looks like it wants to continue to roll on up and follow along with the S&P and the NASDAQ. Quick check-in on the VIX. The VIX continues to come off. In fact, on Wednesday, the VIX hit a 5-month low, currently sitting at 15.37, so that continues to look great. For the overall market, shows confidence anytime you're below 20, shows confidence, stability. Anytime you're above 20, it shows a lot of instability and uncertainty in really just the overall market. And let's do a quick check-in on Bitcoin as well. Bitcoin right now, at time of recording, we are sitting just a hair under 119,000. And we seem to be in this bull pennant, if you will, and really looking to break out of this and break a new all-time high, which was previously 123. So a bit of consolidation here. I would fully expect this to do the same thing the Russell 2000 did and get a nice little green candle breaking out above this, because that is the trend of the market right now, folks. And Bitcoin is a risk-on asset, and we are clearly in a risk-on environment right now. So that's what I'm watching. Quick side note, if you're not familiar, this is TradingView. There's a ton on here. Great indicators and really great support, just great community. If you're interested in it, I got a link in the description below. Make sure to click on it, check it out. And with that, let's move on to the Magnificent Seven earnings. So first of all, Alphabet beats earnings expectations, raises spending forecast. So Alphabet reported second quarter results on Wednesday that beat on revenue and earnings, but the company said it would raise its capital investments by $10 billion in 2025. Shares of the company were up as much as 3% in after-hours trading. Here's how the company did. Revenue, $96.43 billion versus $94 billion. That's a beat. Earnings per share, $2.31 versus $2.18 expected. That's also a beat. Wall Street is also watching several other numbers in the report. So, for example, YouTube advertising revenue, $9.8 billion versus $9.56 billion. That's a beat. Google Cloud revenue was a beat as well. Traffic acquisition costs was also a beat. The company's overall revenue grew 14% year over year, higher than the 10.9% Wall Street expected. So this is awesome news if you are a Google investor, and it's always good to see a Magnificent Seven company that is doing good. Let's be honest, that's just good for the overall market in general. So if we take a look at Google here, and after hours had a nice little uptick, and we're sitting pretty good there. We had a peak of 198. Looks like we closed out after hours trading at 195, which is up about 4 points from where it closed at 4 p.m. And as far as an all-time high, you got 208, and we are above all major moving averages. So Google's looking pretty good. Now let's move on to another Magnificent Seven stock that did not look as good, as far as earnings go at least. Tesla reports sales miss as auto revenue drops for second straight quarter. Not great. Tesla reported a 16% decline in automotive revenue as sales fell for a second straight quarter and again trailed analyst estimates. Here's how the company did compare with estimates from analysts polled by LSEG. Earnings per share, 40 cents adjusted versus 43 cents expected. Not great. Revenue, $22.50 billion versus $22.74 billion. That did not beat. Auto revenue for Tesla came in at $16.7 billion in the second quarter, down from $19.9 billion in the same quarter last year. Of that sum, revenue from sales of auto regulatory credits declined to $439 million from $890 million a year earlier. That's pretty big. So as of right now, the earnings for Tesla did not look fantastic. And, there's a lot going on with this company. We've talked about it before. Elon wanted to start his own political adventures, right? And now I've seen some reports of late that, he's literally sleeping at the office, which is good news if you're a Tesla investor, because it means that he's focusing on the business, right? But if we take a look at Tesla on the charts and see how we're looking right now on a daily chart, over the past year, taking a look here, got some key levels laid out, but we are kind of in this wedge right now that's really been forming since I would say about beginning of June, really looking to see if we're going to break this descending level of resistance. We got this ascending level of support, and one of the two is going to give. It's just a matter of when. If we take a look at a 4-hour chart, after hours, of course, based off that earnings report, not great. Dropped to 317, folks. That is a massive, massive dump on Tesla, even for Tesla, right? Which is a high beta. If you bought puts today, heading into the close at 332, you're already looking at 15 points to the downside. So that's where we're sitting right now on Tesla. Not great. We'll see if it can find some support in the morning. But honestly, if I was looking to scalp this in the morning, which I might, I would be looking to the put side, especially based off that earnings. So we'll just have to see how things stabilize right now. But as of right now, we're basically sitting at the 200-day moving average on the daily time frame. So we'll see if that can hold. That should be support for the company. But if it breaks down below there, we might get a retest of this ascending level of support. And you also have a very, very important level way down there, the 61.8% Fibonacci retracement level of basically $300, right? We will see what happens there. That's the latest on some of the Magnificent Seven, some of the earnings that happened on Wednesday. Now let's get into some macro news from the administration. So this, according to CNBC, Trump announces massive trade deal with Japan setting tariffs at 15%. President Donald Trump on Tuesday stateside announced a massive deal with Japan that includes reciprocal tariffs on 15% of the country's exports to the U.S., with auto duties reportedly being lowered to that level as well. In a post on Truth Social, Trump called the agreement perhaps the largest deal ever made, while adding that Japan would invest $550 billion in the United States and the U.S. would receive 90% of the profits. Trump said that Japan will open their country to trade, including cars and trucks, rice, and certain other agricultural products and other things. The U.S. president added that the deal would create hundreds of thousands of jobs. Following Trump's post, Japanese Prime Minister said that auto tariffs on Tokyo will be lowered to 15% from the current 25% that is levied against countries. Part of the deal, Reuters reported. Auto exports to the U.S. are a cornerstone of Japan's economy, making up 28.3% of all shipments in 2024. Great news. We continue to see, tariff deals getting done, which is great to see. And Japan is a fairly big one. It's a fairly sizable one. I think some of the early criticism with some of the deals that we got coming in was that, hey, these aren't major trade partners with the U.S. We want to see some meat and potatoes, for lack of a better term. And I think we kind of got some of that on Wednesday with Japan. So good news here. We'll see what else can shake out the remainder of this week. I've heard that basically the European Union and the U.S. are coming to a deal. Things are looking, pretty promising there. That would also be a major one as well. And so really this is part of the reason why we continue to get the markets ripping at all-time highs. The market is digesting tariff news differently than it did in April. You said the word tariff and you got a drop on the S&P 500 almost 15%, right? In April, everyone was terrified of tariffs. And at this point, the market is digesting it differently. So as of right now, that's what we got. We'll wait and see what happens with the EU, but we got to deal with Japan. So that is great news. And now let's move on to Opendoor and really just the meme frenzy that has been going on. So if you recall, we talked about Opendoor on our market prep video, our midweek check-in last Thursday, and then also on the market prep video on Sunday as well. And then on Monday, folks, that thing ripped. It was up over 100%. It was up 110%. And the trading volume on Opendoor was absolutely insane. It was, I believe, almost 2 billion, which is insane considering the amount of shares available to trade on Opendoor is something like 700 million. That means basically shares traded hands, over every single share traded hands more than once just on that day alone on Monday. So absolutely insane day. And the meme frenzy is definitely back. So let's get into it. Yahoo Finance here. Krispy Kreme, GoPro both soar as the next darlings of the summer's meme stock resurgence. GoPro and Krispy Kreme had a stint Wednesday as the latest stars of a meme stock resurgence that has swept markets this summer. GoPro stock gained as much as 90% in pre-market trading on Wednesday before appalling gains to close up roughly 12.4%. Krispy Kreme stock rose as much as 70% before the open and then pulled back to a gain of roughly 4.5% at the close. The sub-billion-dollar companies have become the latest names after Opendoor and Kohl's started earlier this week in a meme stock rally that has dominated the market conversation. One-time hardware and media tech breakout GoPro saw its stock trade as high as $98.47 in the months after its mild 2014 IPO, but 10 years later, the stock has lost roughly 98% of its value. Shares closed on Monday at $1.37. So we have a lot of what I would call sympathy plays happening right now, which really just confirms to me that we are in a position right now where we are entering a meme summer frenzy. So if we check apewisdom.io, trending stocks on Reddit in the past 24 hours, Opendoor remains the top. And then you got rocket companies, you got Krispy Kreme creeping up there. Kohl's is number 7 right now. And so you can see that as of right now, you got some of these meme stocks, as we're going to start calling them, because they're getting pumped by, Wall Street bets and really just the retail community. I mean, this is all fitting the recipe of another meme frenzy, similar to what we saw in 2021. And just a quick check-in on the charts for some of these. It's very interesting how these things kind of play out, right? How the volume just kind of comes in, and really they all have very, very similar features in the sense that the retail community is paying attention to it. They are highly shorted, of course. Let's take a look at Rocket Mortgage. And if we just take a look at a 4-hour chart over the past 10 hours, this thing went from, basically $13 up to almost $20, and then wasn't able to hold that today. GoPro, as I just mentioned, is another one, popped and failed. You got Kohl's, which has just been wild as well. It was around $10, skyrocketed to 21, back down to 12. I mean, the list goes on and on. Krispy Kreme, same thing. So we are definitely in an environment where highly shorted stocks are being targeted. And then, of course, you got Opendoor, which we will get into here. I mean, we talked about this on Sunday, right? We talked about the fact that this is a company, and we're going to get into some of the reasonings, I believe, why it's worth paying attention to. But this is a company that had been very, very beaten down, right? I mean, it was trading at 50 cents, kind of left for dead. And as Eric Jackson has said in some of his interviews and various things, if you've been paying attention to him, he's essentially saying that the stock is being treated as if it's dead when it's really not dead. So I think that's really what grabbed everyone's attention. And the fact that Wall Street Bets got a hold of it was kind of the beginnings, right? But one of the things that I find interesting about Opendoor is that it feels, this whole ride right now with all these meme stocks, it feels very, very similar to 2021, what we saw with AMC, GameStop. You had BlackBerry and some other sympathy plays. And, let me be clear. I'm not saying that Opendoor is going to be like GameStop. Nothing will ever be like GameStop. So let me just be very, very, very clear about that. However, if you, let's say, put a gun to my head and made me pick out of all these recent meme stocks that have been blowing up over the past couple of days, if I had to pick one of them that seemed most similar to GameStop in 2021, I would pick Opendoor. It was the first one. GameStop was the first one. And then you had sympathy plays, right? AMC, BlackBerry from 2021, right? Just to name a couple. And flash forward to 2025 right now, and you have sympathy plays around Opendoor, Rocket Mortgage. You have GoPro. You have Krispy Kreme. You got Kohl's, right? You have all these, what I'm calling sympathy plays, because Opendoor was the initial play. It was the initial one that took off, really started taking off last week, and now you're getting these sympathy plays starting up this week. So I think that out of all of them, I think Opendoor is the main one to be paying attention to because it was the first one, right? So that's kind of my thesis on it. And let me be clear, this is not financial advice, but, I want to make sure that I give a full breakdown of it. And also, to be fully transparent, I do have a position in this. I have some shares, I have some calls. I'm riding the wave. I want to see where this thing goes because I find the story interesting, right? So I want to make sure, unlike some of the other channels that, we have seen in the past with GameStop and AMC, kind of put out some false information, kind of pump things up artificially, give false hope, unrealistic expectations, right? That's not what I want to do on this channel. I want to make sure I'm fully transparent. And, I'm not going to give price predictions or anything like that. I just kind of want to lay out the facts and just kind of explain what I'm seeing on the charts. Maybe you see it too, maybe you don't. But either way, this is nevertheless a very interesting story in the markets right now, and that's why we're covering it. So first of all, as far as the short interest on this, so I saw an interesting post on Tuesday from Ortex. Heavy action in open today, 28.4% short interest. That's a bump of 4.6% on the day. So this was on Tuesday. 8.57 million shares shorted today. So we continue to see a spike in the overall short interest on Opendoor. It was around 20%. It's showing 20% if you check sites like Fintel that might not be updated yet. But this is as of Tuesday, 28.4%. So heavily shorted. If anything, the shorts are, more invested into this than they were prior. Again, when we saw numbers of 20%, now, we're essentially pushing 30% short interest. So it's only going up, right? And so that's just kind of more fuel on the fire if we begin to turn to the upside. So this was also interesting from Eric Jackson. I believe this was earlier today. He said, a reporter told me earlier that they did some research and a lot more institutional buying has been happening in the last few days in Open than all the other meme stocks versus retail. He asked if I know why. I said I didn't, but I guess it is because they are being smart. And then he said, this should make the round 2 run at $5 more interesting if true. And I'll get into what he means by that. If you've been paying attention to any of the price action on Open, $5 was a very, very important level. But I found this very, very interesting that, we basically, at least according to him, this reporter told him that, there's a lot more institutional buying happening of late in Open. So, and here's the big thing, than all other meme stocks, right? So basically, more institutional buying is happening in Open versus other meme stocks. This is another reason why I think you should be, if you are paying attention to any of the meme stocks that have been going off of late, that's why, in my opinion, the one to pay attention to the most is going to be Open, especially if this is a valid statement, if this is factual, if this is true, that more institutional buying is happening there in particular. That's a big alarm bell in my head to be bullish on this if you're going to get involved. I thought that was an interesting post, saw that earlier. And if we take a look at Open, right? So this was Monday. We had this massive, insane run up over 100%. And then we ran into resistance just under $5 at $4.97. And really, we basically consolidated just for a little bit at that level. And it did not hold. Obviously, we had a giant rug pull that ended up happening there. But, it basically almost got to 5, a little bit of consolidation. Obviously, there wasn't enough buying pressure. There wasn't enough demand. We fell off, and really we've been selling off since then, which in my opinion is not a bad thing. And here's why. We were so overheated on this daily chart, folks, and we still kind of are, to be honest with you. I'm not going to sit here and say, stocks only go up. That's not true. But basically, after that run, we had an RSI on the daily sitting at 94. Even on the weekly, we were technically overbought on the RSI. This thing needed to cool off. And that's what we are getting, like it or not, over the past couple days. Tuesday was a massive red day. You had this nasty Monday candle here. That's never a good sign when you get a giant wick like this. Price got pushed down, closed around, 320. And then on Tuesday, we had another big red day as we continued to kind of sell off after such a big run. We needed a chance to cool off, especially on the RSI. And then on Wednesday as well, was another red day. And so I don't believe this play is over. I'll be clear about that. And I'll also explain where I think this play could be over, at least in my humble opinion. But as of right now, we're just basically cooling off. That's how I'm viewing it. Yeah, I got some calls. They're kind of longer dated. I'm not really worried about what happens in the next 30 minutes or the next day or two. I'm more concerned about, hey, what's the next month? What does August look like? What does September look like? But, we need to cool off. And so as of Wednesday, we had an RSI sitting at 67, which is a lot better than 95. So, we're beginning to cool off a little bit on that, which is a good sign. And another interesting thing, too, about Opendoor is if you take a look at the volume, right? So obviously we've had historic volume over the past couple of days. I talked about it earlier. We had almost 2 billion shares trading hands on Monday alone, over 1.8 billion. That's massive. And then you take a look at Tuesday, we had almost half of that. And then we take a look at Wednesday, and you had half of that. So the volume is dissipating. Now, there's a couple of different ways you can kind of look at that. You can say, oh, the momentum's dying. You could also say, hey, the fact that we're having lower volume on red days is a good thing. It shows less conviction in the down move. It shows more of a kind of cooling off, if you will, versus having, massive red days on big volume. That shows a lot of conviction, institutional action to the downside, right? But we're not really seeing that. We're seeing half the volume each day versus the giant green day that we had on Monday. So I think that's a good thing. And the reason why I don't think it's necessarily dying momentum is because of the fact that we are still well above the R-vol, the relative volume for this company, which is right around, I believe, 60, maybe 70 million shares exchanging hands per day. We are still well above that, which tells me that there's still a lot of activity on this, still a lot of attention, which is just simply confirmed by these massive volume candles. So I think we're just kind of cooling off right now. Now, as far as the Fibonacci levels, I put together a Fibonacci retracement from the all-time low 51 cents that we had back in June to that 497 high that we had on Monday, and kind of laid out some key levels here that I'm paying attention to. So 61.8% is a very deep retracement. Usually if you don't get a bounce there, it's not going to happen. And on Wednesday, we saw a promising daily candle close where we did wick below that 61.8%, but then buyers stepped in, bought it back up, and it closed above that level after testing it. And also, in addition to that, we did close the gap. We had a gap here from Friday to Monday that needed to be closed. Typically, when you have gaps like this, the odds of them getting filled at some point are very high. There's the market needs to, experiment with those price levels, and it's basically just considered price discovery, right? You got an imbalance there, and so the market filled it today, which is good. So now that that's filled, let's see if we can build a base here, maybe consolidate a little bit, and then try to make a run for 274, which is the 50% psychological retracement level. And then, of course, $3, more of a psychological level there as well. Basically, Eric Jackson is saying if all those institutional buyers are indeed there, it's going to make this run up to 5 again very, very interesting. So this was obviously a key level. I mean, the stock got really beaten down at that price point. There was a ton of supply there. And if I was short this, that's basically where I would be placing my stop to get out of the position, would be right around this level, maybe just right above it. So if we get back up here and we're testing that level again and we break above it, you're going to have, for one thing, you're going to have shorts covering. For two, you're going to have a lot of buyers on the sidelines viewing that as a technical reason to get in, and you could have a massive explosion above that. And to add to that, something else to pay attention to here is if we zoom out onto a weekly chart, you have this descending level of resistance here. You got these two touch points that happened right around 540-ish, and then over here at $5. And so basically, if we can get a break above this, that 497 level that was resistance on Monday is kind of, lining up with some of this resistance that we had a couple of years back, right? So if we are able to get a break above 5 and we get a break above that high from back on literally 2 years ago, right? July of 2023, that on a major time frame on a weekly chart signals a whole new trend beginning, and you might just get a run up to $10 or even 15 at that point, as crazy as that sounds. So we will see what happens. I'm no fortune teller, but I do like the way this thing is setting up. And this is what I was talking about. If you look at this is the weekly chart, right? Look at the RSI on this thing. I mean, it's still hot. It's at 73. It's technically overbought. So we may still have some cooling off to do here. So we'll see what happens with Opendoor. And one of the things I wanted to bring up here, one of the original reasons why people got interested in this, right? Obviously, you got Eric Jackson who got involved, but you also have Wall Street Bets And there was a particular individual on Wall Street Bets that really put out, their own DD, their own due diligence. And so I just wanted to break down briefly some of the key fundamental reasons why Opendoor might be something to keep on your watch list and why there's so much attention around it. So according to this Reddit post here, Opendoor to actually make money in Q2. So Q2's estimates is for EBITDA profitability of 5 to 20 million. The first time Opendoor will make a quarterly profit in 3 years. 2025's housing market is even worse than previous years, so this means the business itself is becoming more profitable. Losses are still expected for Q3 and Q4, but they're expected to be smaller than previous years. Path to profitability. So Opendoor lost $392 million last year. Here's how we get to adjusted net income positive. So they basically say $80 million. Opendoor laid off 300 workers in Q4, which saves $20 million a quarter. $75 million. My spreadsheet says Opendoor loses $12,000 per house they buy in summer and fall. They said they are going to stop doing this, so that's $75 million there. $55 million. They spend $4,000 per house more on interest and holding costs than they did in 2021. That's going to be fixed because the housing market will improve and they'll stop buying homes in the summer. $80 million. Opendoor is starting to send customers that don't take their offers to real estate agents, which pay a referral fee, 1% referral fee. 2% of 1.2 million customers times 330,000 average house price. That's $80 million. $130 million from housing appreciation. Opendoor has $2.2 billion in houses that have been depreciating at 1% a year. Should housing return to a historically normal 5% rate of appreciation, that's $130 million in profit. That's already $420 million in savings, enough to be profitable. Revenue should also grow higher as the housing market unfreezes, and marketing spend should be more effective as they learn to partner with real estate agents. Basically, what they're laying out here is, again, the path of profitability, right? So they're laying out their case for why they believe this company can turn a profit. And this is very, very interesting. Also, considering the fact that we have earnings coming up for Opendoor, which is going to be on August 8th, I believe. So also debt refinancing, cash to scale throughout next 2 years. So on May 9th, Opendoor announced it had exchanged $245 million in existing convertible bonds due in March for new convertible bonds due in 2030, a 7% rate, convertible at $1.57. Opendoor also issued $75 million in new bonds, raising $75 million in new capital. $135 million in bonds is still due in 2026, but this will be easily payable with cash on hand. Following the equity raise and bond refinance, Opendoor has $1.1 billion in capital, of which $768 million is cash, $693 million from Q1 report plus $75 million equity they just raised. On the Q4 and Q1 transcripts, management stated they had refinanced 90% of their credit lines through 2026. Management has reassured us that they still have available cash and personnel to return to a much larger scale of operations. In the Q1 report, they stated that only $350 million of their cash is invested in homes, and they have $559 million, probably $634 million now, available to deploy towards home purchases. They are also only using $2 billion of their existing $8 billion credit line. That's interesting. From these numbers, it seems they have the financing to purchase 3 times more homes than they currently are. Management has guided that they are capable of purchasing many more homes, but they're choosing to purchase less. While the housing market is slow and margins are low, I expect them to deploy this capital and scale in Q4, assuming mortgage rates start to fall. Very interesting. So they refinance their debt and they're basically restructuring their business. It puts them in a better position. I also like the fact that they're only using $2 billion of their $8 billion credit line. I think that's very interesting as well. So all that to say, and I'll kind of end it with this, but the conclusion, at least from this Reddit post, Opendoor is a stupid company that made over $1 billion of home flipping profit in 2021 when the housing market was good. Then their CEO lit $1 billion on fire buying overpriced houses. He was fired and replaced with a responsible CFO. They've been learning important lessons. Realtors exist for a reason, and house prices go up in the summer. Now that they know these things, they can make money. When Jerome Powell fixes the housing market, they'll make even more money, and the stock will pull a Carvana and go up 100x. Also, Opendoor just refinanced its debt, so it's very much not dead. They have over $1 billion still, enough for at least 2 years, more if they fix their business as planned or if the Fed fixes it for them. Also, last month's price action was probably just the hedge funds shorting Opendoor to kick it out of the Russell 2000 and abuse the poor ETFs that will have to sell at a low price. I'm hoping the stock triples after the shorts close, probably on June 27th. That is very interesting considering the fact they said June 27th, and if we take a look at what we've been experiencing, I mean, almost to a T, right? Basically at the end of June is what that person on Reddit was assuming we would probably see some kind of crazy return. Wasn't too far off, actually. It started picking up beginning of July, pretty spot on. And, we've had some pretty insane returns on this from the bottom, over 500%. So I just thought that was interesting, and I saw that and wanted to share that because I think it's important when you're looking at any company. First of all, you got to know what your time horizon is. Is this a trade? Is this a scalp? Is this a position? Is this a long-term position, right? You gotta figure out what you're doing. And, for me, like I said, I have shares, I have calls. Some of it is going to be more short-term swing trades. Some of it is going to be more long-term. And when I'm looking at anything on the long term, really the more long-term you get, the more fundamental basis you want to have. On the short-term side, I don't really care about fundamentals, right? When I'm trading, when I'm swing trading, I don't really care about fundamentals all that much. I'm paying more attention to technical analysis, chart patterns. But when you're talking about holding something for, let's say, a year or 2 years, something like that, you want to know what the fundamental reason is. And so that's why I want to share that, some of the fundamentals of Opendoor and what a lot of people are paying attention to right now. It's getting a lot of traction right now. Look, I don't know what's going to happen to it, but it's a very interesting story. And I just love seeing the meme frenzy from 2021 coming back. I love it. I'm here for it. So as far as what I believe would invalidate this move, honestly, at this point, I think $2 is really it. If we cannot hold above $2, then I'm willing to put up the white flag, say, hey, that was a fun ride to almost $5 on Monday, but this thing is dead in the water, especially if we see volume dry up. However, if we are able to defend that Fibonacci level of 221 like we did on Wednesday, and we see the volume continue to sustain, maybe not in the billion level, but see elevated volume, right? Then I think this thing could get really interesting over the next couple of weeks. I don't know how long it'll take, but I think if we are able to get back above, $3, this thing could try another crack at that high that we had on Monday, almost $5. Really, that's the line in the sand, in my opinion, is $5. If you get above $5, things get really, really interesting, really, really fast. That's my 2 cents. So we will see what happens there. That is the latest on Opendoor. We, of course, will be keeping tabs on that. Real quick here, just want to lay out some of the key economic data just to wrap up the episode that, we need to be paying attention to. So on Wednesday, we had existing home sales, which came in a little bit less than forecasted at 4 million, actually came in at 3.93 million. Thursday, hopefully by the time you see this, the numbers aren't out yet. This comes out at 8 a.m. on Thursday morning. So we'll, these numbers come out 30 minutes later, so maybe you'll miss it by then. But initial jobless claims coming out 8:30 a.m. Eastern, July 24th. Previous 221,000. We got a forecast of 227,000. We get S&P Global Manufacturing PMI, S&P Global Services PMI, new home sales coming out at 10 a.m. And then on Friday, July 25th, durable goods orders. So those are some of the key volatile economic reports that you need to be paying attention to if you are a more active trader. So that's what I got for this midweek check-in. We broke down a lot. You got Magnificent 7 earnings. We're going to continue. We are right in the middle of Q2 earnings season. So we're going to continue to get big tech earnings coming out. We'll make sure to break those down, see what the latest is on any new tariff updates from President Trump and his administration, and of course, keep tabs on the summer meme frenzy as it develops. So appreciate all the support as always. Make sure to share this with a buddy. Drop a comment. Let me know what you think about Opendoor. Do you think it's dead in the water? Do you think it's on its way back to 50 cents? Or do we have the beginnings of potentially another big meme squeeze? Would love to get your take. Thanks a lot. Make sure to like, subscribe, and follow wherever you listen to podcasts. And folks, as always, remember, plan the trade and trade the plan. Have a good one.